Hi, my name is Paul Skeith, and I'm a business lawyer practicing in Austin, Texas. This week, I'd like to talk about pre-money versus post-money valuations. These terms get confused often by business owners and even investors who are new to investing in private businesses. So let's start first with pre-money valuation. A pre-money valuation is just the market value of the business before you take into account the new money that comes in from an investor. So this is how I think most owners think of the valuation of their business to begin with. What's it worth right now before the investor money comes in? Now, take a look at post-money valuation. What post-money valuation means is the market value of the business after the new money comes in, right? So another way of saying this is pre-money valuation plus the money that comes in equals the post-money valuation. Makes sense, right? So why is this important? The important piece here is to understand when a potential investor or an owner, when they're discussing valuation, it's important to know, are they talking about pre-money or post-money? And why? Well, here's an example. So suppose that an investor says, I'm willing to give a valuation on this company of $10 million post-money, right? And willing to invest $4 million in a company that is worth $10 million post-money. So what's the investor thinking that percentage ownership is going to be? Well, the investor is thinking about 67%. So why is that? Well, $4 million, right, divided by $6 million is 67% about, right? So why the $6 million? Because remember, post-money valuation is pre-money plus money in post-money, right? So really 10 million post-money is exactly the same as saying 6 million pre-money. Okay, so suppose that what really the investor and the owner meant in that negotiation was $10 million pre-money. Okay, well in that situation, $10 million pre-money, the investor with the same $4 million investment is expecting 40%. Why? Well, $4 million divided by $10 million gets you 40% of the company. A lot of real world examples are more complicated than that, but that's the basic gist of how pre-money and post-money works. So as you can see, which valuation method is being discussed has a big impact on ownership percentages. So that's why it's so important for both owners and investors to be clear up front so everybody knows which valuation method they're talking about and can have a solid expectation of what percentage of the company the investor is expecting for their investment.